The most critical economic signal is surging to dangerous levels, and what comes next could shock us all. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, this spiking indicator has a track record of predicting recessions, and as you're about to see, the consequences could be devastating. But one expert says that tariffs are the solution. But are they? Now let's head over to Bloomberg, where we picked today's story up by the headline. As U.S. jobless claims rise slightly, but recurring applications surge. And this is something that we've been warning about. And it's pretty normal that after the holiday season, we see initial applications and continued claims rise. But what we've been warning about, if the continued claims continue to go higher, it was almost certain chance that we're headed into a recession. And let me give you the evidence of this as we take a look at why continued claims are headed higher. Let's look at this chart of advanced retail sales adjusted for inflation, or what's called real retail sales. That's shown in blue on a year-over-year rate of change. We're going to compare it to continued unemployment claims in red. Now, we can go back to the late 1990s, and we see a peak in real retail sales, and then it rolls over and heads down. Now, we'll note that continued claims continue to decline, which is positive for the economy, but the problem is, due to a decline in sales, what we see is continued claims bottom out, and then they head higher. The issue starts to happen is when people hit the unemployment line and they have no opportunities to re-enter the workforce, well, that's when the whole thing starts to snowball. Let's fast forward to 2006, where we see real retail sales start to slow down, and it doesn't have an immediate impact on the labor market, but around 2007, we start to see that workers are unable to re-enter the workforce, and at that point, we see continued claims skyrocket and real retail sales plunge. Well, let's move forward to around 2018, where we see once again real retail sales are slowing. The labor market has some ability to adjust for this, but it struggles. We won't know exactly what happened because a pandemic would follow, but it was likely we were headed into a recession to begin with. Now, let's turn to 2022. What happens? Real retail sales are plunging without the pandemic stimulus, and then it enters a 3-year period where real retail sales are largely negative. What happens shortly after we enter 2022? Continued claims bottom, they head higher, and the risk here is that if continued claims continue to go up, it means we're going to see a severe lack in demand, and that lack of demand snowballs as workers cannot find new jobs. And this impacts everybody all the way up into the manufacturing sector, the shipping, delivery, wholesaling. Every aspect of the economy gets affected when people hit the unemployment line. Continued claims are proxy for people who are already receiving benefits and still can't find a job, jumped to 1.9 million in the week ending January 11th, the highest now since November of 2021. Initial claims, though, only increased 6,000 to 223,000 last week. But the risk is, and this is a case we've been making, where continued claims go, initial claims fall. That's why this is such a dangerous economic signal, and perhaps the most important one right now, because if claims continue to rise, what it says is the U.S. economy is all but certain to be in the early stages of recession. Let's take a look at this chart of continued claims in blue against initial claims in red, and you can see the relationship going all the way back to the 1960s. Where continued claims go, initial claims in red follow each and every time. And right now, initial claims remain rather low, but continued claims continue to slowly move higher. The risk is, due to that lack of demand from all the people on unemployment, it backfeeds into the economy. Next thing you know, you start to hear warnings of employers laying off in huge ways, and there's nothing at this point that anyone can do to stop it. And new applications have hovered near their pre-pandemic averages, a sign of a healthy labor market, which is true. The claims level is rather low, but the rise in recurring claims suggests more unemployed people are having a tougher time finding a new job, and that is the risk to the economy. There is no greater risk than people being on the unemployment line, because not only does their incomes drop, but if they start to believe that there's no work out there, and that's what we see in continued unemployment claims, is that there isn't, they're going to spend even less. Because when you lose your job and you think, well, it's not a problem, I'm going to get another job here in a matter of weeks or a couple of months, people will still spend. But if there's no opportunity, they're going to tighten their budget. And you think about what's been going on. We've had rising inflation. Insurance costs are up. We see food costs, energy costs, all impacting households. Means less money spent on the discretionary side of the economy, and that means fewer jobs. And there's been some of the usual elevated volatility in the weekly reads for this time of year. And again, that's pretty normal in terms of what we see post-holiday season. And one thing I warned about last week is we need to see these claims numbers drop and drop in a big way, because if they don't, then it's the clearest sign that we have that the U.S. economy is headed in the wrong direction. Some blame weather and natural disasters are likely to say the figures will be fluid over the next couple of weeks. But the issue is simple. If your employer's building that you work out of burned down and you have nowhere to work, there's a good chance you're not going back to work. And that's one of the challenges of natural disasters. They can put some people out of work permanently, while other people are only out of work temporarily. We just don't know what the final impact will be. But the economy says, look, we think inflation is headed higher. Now, I'm going to make the case of why this isn't, as inflation-linked bonds may draw the highest yield since the 2008 crisis, as investors are betting on inflation during Trump's second term. This means bond prices are falling, interest rates are rising. But is that going to be the real case here? Well, what we're seeing in the labor market suggests otherwise. The rise in inflation-protected yields reflects a combination of underlying growth fundamentals and the market pricing in longer real-term premiums as a result of concerns about fiscal outlook. So what the market's saying is, look, we think the Republican administration is going to spend big, drive even larger deficits, and that's going to lead to inflation. The labor market is telling us the exact opposite is likely to happen. But something else that should be surging is your trading account. Check out this trade. We put this on our Sunday show back on the 17th and the 21st. We told our subscribers to buy uranium. Now, if you're trading momentum, you want to sign up for a Momentum Time Pro, because we run a proprietary overlay that smooths out those momentum signals. We give you great trade setups. Look at this. Since the 17th, it's up 9.65% versus the S&P. It's up 1.59. A couple days later, our machine positioning. This is a fantastic report that gets great deep signals. We position you to buy in before the machines. Here you see it beating the market easily, up 7.59% versus the S&P, up 0.96%. And here's a great thing. That trade is still going up. We told our subscribers today, raise their stop loss levels. You're making money. Let's hang on to it. Now, what do you get? The daily reports. You get the tradable signals. I review all the trades and I tell you, these are the ones I think you should look at and trade. We fully backtest all the reports. We give you the data, risk control levels, and a weekly update of all the trades, including my own trades. That's right. This goes all of my trades. I trade right off my reports, and you can trade right alongside me. Here's the best part. You can still jump on that 30-day free trial. Why do we do that? Because I want you to make money. I want you to see how easy it is to make money in this market. Links in the description below, because one thing people are going to need going forward is the ability to make money, because the labor market's not going to be the answer as we look to inflation. And the market, again, is pricing in a higher inflation. But what happens if we see inflation and unemployment rise at the same time? Well, let's take a look. Let's go back to 2000, and what do we see? Inflation is rising, this starts to peak, but the problem is the continued unemployment claims start to rise, and what happens? You see that gray shaded bar, you get a dot-com bubble, you hit a recession. Now let's move forward to the global financial crisis. What did we see around 2006? Inflation had come down, which is great for the economy, but due to rising energy prices, it starts to jump. That's the point that breaks the labor market. We see continued claims start to move higher, and then they spiral out of control. Once again, right into a recession, except that time was a financial crisis. Let's fast forward to the pandemic years, and what do we see in 2018? Inflation slows down, and then it surges higher as an impact on the labor market. But again, we don't know what would have actually happened due to the pandemic. And let's look at where we're at now. Since 2022, inflation is coming down, but the market thinks it's going to go higher. But look at what the labor market is telling you. If inflation goes higher at this point, it's going to send us right into a recession. Now, keep in mind, our small and mid-sized regional banks are insolvent. We've talked about how they're upside down on their treasury securities, how they're upside down on their loan books, and people are looking to work from home for extended periods of time. But if we get a rash of unemployment, what it means is office space demand is going to plunge. We're likely to have another financial crisis. The situation doesn't look good. The economy has held up well despite higher interest rates. This from Barclays Capital. The Federal Reserve's ongoing reduction holding the treasury rates is also a factor. So everybody still believes that inflation is going to go up, but the labor market is telling you the exact opposite. Because when people get on the unemployment line and their spending drops, and in particular when they don't see opportunities to re-enter the workforce, their spending goes down even more. Inflation comes crashing down. We saw that during the global financial crisis, that high inflation turned into outright deflation. But let's talk about the bond market, because everyone thinks rates can go higher, but not when the economy falls apart. So now we'll just take a look at 10-year treasury yields. These are not inflation adjusted against continued unemployment claims. And you can see what happens when continued claims start to rise, interest rates go down. We see that happen right around 1999 into the dot-com bubble. We see it happen again going into the global financial crisis. It's very clear once again going into the pandemic. And how about now? This time, investors say no, interest rates need to go up. 10-year treasury yields need to be 5%. The government needs to pay. Inflation is going to be a huge problem. The labor market says no, rates need to be coming down. So what's happening here is U.S. investors are betting against the bond market. They believe bond prices are going down, interest rates are going up, and what they don't realize is that move is creating big problems for U.S. consumers who are drowning under massive amounts of high interest credit card debt. They want to go finance things, they want to refinance debt, but they can't because rates are too high. The deals just aren't there for them, and we're seeing that now backfeed into the economy because this is all about demand. We talk about how critical the labor market is, and that's why we talk about continued unemployment claims every week, because look what's happening. Let's talk about what happened in Germany as Puma plunges after profit warning highlights Adidas's lead. And this is dangerous because if you look at their net income, it was 24 million with estimates of 54 million. Now the problem is that means for Puma, their expenses were too high. And what happens when demand goes down and expenses rise? What do companies do? They lay people off. And when we look at the labor market, particularly here in the US, we're already seeing signs that there's nowhere for people to go if they lose their jobs. But it gets worse. And Puma announced cost cuts to reach a goal for its earnings margin before interest and taxes of 8.5% by 2027. The company cited personnel expenses as part of the cost-cutting program, suggesting there could be job reductions, but it didn't offer details. And see, when push comes to shove, when it's all about profits, companies will cut every expense they can. And when they can't cut anymore, they will cut jobs. Again, the problem is the labor market around the world cannot absorb people hitting the unemployment line. And even American Airlines now sees a surprise loss and break from bullish rivals, meaning there's a good chance they're going to be laying people off too. As American is still grappling with the fallout from its ill-fated corporate sales strategy, as well as non-fuel expenses rising more than expected this quarter. The revenue outlook looks bright, but non-fuel costs are expected above our estimates and consensus. Now, what does that mean? If their costs are too high, they're probably going to be facing their ultimate, and that is laying off employees, particularly if they see a downturn, which we'll find out, of course, what happens this first quarter. But based on what we see in continued unemployment claims, it means consumers are going to spend less. And when they spend less, it has an impact on earnings and profits, and that means, of course, it has an impact on wage growth. Here we're going to look at corporate profits after tax against average hourly earnings of production and non-supervisory employees, that in blue. And when profits decline, wage growth declines. You see this happen each and every time. So what is this telling us? That already consumers cannot keep up with inflation. And of course, that means if profits are an issue, if they're not hitting their target, companies will lay people off. And we look at where we're at now. If we were to see an increase in inflation against a big drawdown as average hourly earnings continues to slide, this means workers are unable to keep up with inflation as it is. It's only going to get worse. That means they're going to spend even less, more Americans on the unemployment line. But one expert says tariffs are the answer. But are they? As Jamie Dimon on tariffs, he says, well, get over it. They're coming. And he says tariffs are an economic tool or an economic weapon, depending on how they're used. I would put it in perspective. If it's a little inflationary, but it's good for national security, so be it. I mean, hey, just get over it. But is that it? Is it just that simple that, hey, we should all just expect that tariffs are coming, the prices are going to go up, and we just need to get over it? The problem is the average American household can't get over it. That's the issue. And those on unemployment, they're not going to to get over it either. However, Diamond said these threats can be used to effectively bring people to the table. He's referring to the negotiating table to negotiate a more favorable trade terms. He believes the Trump administration is attempting to use them that way. And that could mean the U.S. imposes lower tariffs on Mexico, Canada, and China compared to the rates Trump has floated, or perhaps no new tariffs at all. We're going to find out, he said. And yes, it is a way to get people to talk, because if you threaten them, they might probably come talk to you, and we know that's going to happen. But is the U.S. consumer in a position to absorb tariffs? Well, that's the issue. And however, there's some debate amongst economists as to whether tariffs alone will cause a one-time increase in prices, or if consumers will grow accustomed to expecting higher prices in the future as a result of tariffs, leading to potentially higher inflation. The issue here, and this is why we talked about continued unemployment claims, is if we see a spike in inflation, what happens? It's going to lead to less demand. We're already seeing households not in a position. They're not seeing their wage growth. They're not seeing their hours work grow, and people on unemployment cannot find another job. So yes, if there are tariffs and they do cause a spike in prices, which is highly likely that they will, they're going to get rejected. That's a huge problem. Here we take a look at, again, a consumer price index shown in blue against continued unemployment claims in red. Let's reiterate the fact is that when prices rise and people are on unemployment, what happens? You go right into a recession. So at this point, if we did see a big tariff come through, it's going to be passed through on prices, and it's going to put us right into recession, because look what happens after that spike in prices. Well, you get a disinflationary trend here, and around 2008, disinflation turns into deflation, and look what would happen now. Yes, prices would spike in the short term. It would likely lead to more Americans on the unemployment line, and then inflation would come crashing down. So in terms of the answer to the question, are tariffs the solution? It doesn't appear so. But when we look at continued unemployment claims and we talk about the labor market, the most dangerous economic signal right now is moving higher. It's going in the wrong direction. And if this persists over the next couple of weeks, well, there's no question the U.S. economy is in a recession, and this is only beginning of how worse it can get. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.